Good afternoon. This is Don Burgle. I'm the Chief Marketing Officer at Avoca. I'm in Broomfield, Colorado. Thank you for joining our webinar today, Agile Digital Onboarding for Wealth Management. Joining me on the conference are a couple of speakers. First up is going to be Alois Perker. He is a Research Director at IT Group in New York. And also with me are Derek Corcoran. He is the Chief Experience Officer here at Avoca. So the webinar today will take about 40 minutes. You'll hear from two speakers, and then we'll have time for Q&A session. We won't be taking voice Q&A, but rather when you have a question, type it into the chat window in the lower left of your screen. We'll batch up those questions and we'll address them at the end of the session. So with that, I'd like to turn it over to Alois from IT Group, and he will deliver the first part of our presentation on onboarding wealth management.
Thanks, Don. Appreciate it. Hello, everyone. My name is Alois Perker. I'm heading up the wealth management practice at IT Group. I'd like to lead into this webinar with some trends in the digital wealth management space. Starting off with a look at what is going on in general in the wealth management space and how is the proposition changing and what the firms need to do in order to stay competitive. When we look at the general market situation in wealth management, we've seen challenging times for wealth management firms. We've seen a low interest rate environment. We've seen for some time low trading volume. We've seen firms trying to increase revenue, but markets not necessarily being kind to them. At the same time, client experience expectations are changing. Clients are not just expecting to get service from advisors, but they would like to get a digital service as well alongside the advisor service. And many of the firms are really not well equipped in delivering that. With these pressures resting on firms, some firms have left the market, have sold the firm. Some advisors have shifted, gone independent to manufacture an own model that is much more up to date and much more what they would like to offer their clients. In general, one of the solutions that firms have been trying to go towards is to move to the high net worth space, looking for much more profitability with larger clients, which can be a banded solution. Some firms can do it better than others. However, what has happened with that move to the high net worth space is that many of the mass affluent clients have become under-advised. They don't have access to advice. And so we have seen startup technology solutions, sometimes referred to as robo-advisor, but quite frankly, that term does the trend not really justice, coming to the market to provide scalable advice to this market, something that traditional firms have not been able to provide in the past. Now, when we look fast forward, the demographic shifts that will hit the industry are severe, and that move to the high net worth space, as I mentioned before, might be giving you short-term profitability, but it doesn't solve your problem of having to come to terms that the service model might not be the best for meeting the needs of the next generation clients. So that as assets are shifting in the intergenerational wealth transfer to the next generation, sometimes it will go via a spouse. Assets will leave traditional firms, and unless firms are really starting to cater to that next generation and starting to update the service models, they will lose those clients. At the same time, obviously, the advisors are an aging population as well, and new advisors are expecting different tools that they offer their clients. Last but not least, obviously regulations are a big topic in industry today, again, particularly with the Department of Labor ruling to having to offer fiduciary service when working with retirement assets to your clients. This also is providing challenges for the industry, and we'll talk a little later about that further. When we look at traditional wealth management models, the picture looks somewhat like this. On the right hand of the x-axis is the traditional service, the advisor-led services. On the left side is the digital technology-delivered service models. As we said before, the advisor-led models have moved up market. They're looking for bigger clients, more profitability, and the digital advisor model has come in to replace that void that has been created at the bottom. Clearly, they hit the finding an underserved segment. They're acting as a low-cost professional service model. They deliver at scale. While they are startup firms, they actually do manage to deliver scale through the digital delivery they have. And the automated digital processes, again, that they have pioneered are allowing them to serve clients in a more value-add type of way. When we compare that model, the digital advice model, with the traditional wealth management model, we can look at comparison on a number of different levels. When we look at the business model features, the traditional wealth management businesses on the left are mostly advisor-led business models, where the client is assigned to a specific advisor. The advisor owns the client relationship. The advisor determines the service schedule. Digital channels are really a byproduct, convenience layer that is added to the advisor, but it's not necessarily delivering value. Products and fees are complex, and typically it's a high-cost, high-fee type of environment. In the digital world, things are drastically different. We have, by default, a multi-channel service, designed as a multi-channel service. The firm typically owns the client relationship, but that could vary from firm to firm. Advisors are really stepping in when needed, when value add is required, and not when mundane processes need to be performed. Digital channels are providing products, services, as well as value-add content. Products are simplified, the product presentation particularly is simple, as well as the fee presentation is simple, and in general it's a much lower fee and lower cost environment. When we look at the products that are offered, again, in the traditional world, it's typically commission-based products moving to fee-based, but complex fee-based products. In the digital world, it's the base proposition is a very simple ETF wrap type of proposition, adding complexity as firms are evolving, like daily tax loss harvesting, proprietary products, or thematic investing. But instead of having an expensive proposition to start out with, it's a really inexpensive proposition as the first step, and then moving into more complexity. That also results in a much lower fee. Traditional firms over 100 basis points, typically digital advice definitely below 100. Most important, I believe, the last two categories. Technology is, in the traditional world, built for professionals and typically extends out to the end client. In the digital world, it really is built for the client first. It's a client understanding of the world, the client experience that's driving what the technology is that is being built. And that is a huge difference to how traditional firms have been extending their business models out to the end client. And then client engagement, obviously, in the traditional world, is largely left to the advisor. In the digital world, it is an online, digital-driven value proposition with content and self-service tools that are adding value to that relationship and not necessarily needing that advisor to handhold. When we look at, obviously many firms are fearing for their advisors or shying away from digital because they feel that the advisor proposition is at risk. We do advisor surveys at IT Group quite frequently, and when we look at what client advisors expect from client-facing technology, it is the acquisition of new clients, that onboarding of new clients, the experience to get to the next client and to serve the next client is really the biggest goal. We also see better serving existing clients, self-service tools, more content, and so on is a top priority, as well as obviously advisor-client collaboration. Many of the processes that have been sitting within the advisor's team or in the back office are being now exposed out to the client and need to be conducted in a collaborative way, so the client is involved and also can drive the experience the way he or she wants. So again, those are three of the key priorities. Not shown here, also in our research, what we have found is that particularly advisors that have fast-growing practices are keen to get digital capabilities, or are keen to leverage digital capabilities. And those that are stagnant with stagnant practices are often those that are shying away from it. So that fear of change in their traditional business model is to a large degree unfounded because, again, the fast-growing advisors see that need for change and want to have that change happen. When we see what firms are the fastest right now in this digitalization drive, it really is asset management firms that are driving a very fast pace and are making acquisitions like BlackRock, the Future Advisor, or Vanguard has rolled out PAS, or Schwab, the Intelligent Portfolio. So where firms that are manufacturing ETFs or index-based products are leveraging digital as a distribution channel and are threatening traditional wealth management firms in the distribution game. Some of those firms obviously are delivering capabilities to advisors. In general, though, we do see a great momentum and desire to adopt in the bank channel. Again, firms like BBVA or Bank of America are very active in thinking about how can they expand their online banking experience to digital investing experience as well. And very often at banks, what you see today is banking has gone digital a while back already, while the wealth management side is driven with advisors and largely a full service, high touch type of business model, only being able to operate a certain small percentage of clients with that business model because obviously it's expensive. With adding digitalization to that mix, you can reach a lot deeper and operate a lot more clients in that context. And that's what high net worth firms, the last group here, are aiming to do as well, is obviously every advisor has clients that are too small, and segmenting the book and operating book, a certain share of the book in a more scalable way is something that firms are keen on doing in order to increase profitability. When we look at the digitalization and how that works out, coming back to that picture I showed earlier in the presentation, we do need to differentiate between adding digital to an advisor's proposition, which is absolutely a necessity as well, because advice clients are expecting a digital experience, or implementing a standalone digital channel, as in the lower half of that picture here. The problem with adding the digital component to the traditional service model, to the full service channel, is that integration area. Many of the processes that are being conducted, typically as mentioned before in the back office or by the advisor or by the advisor's team, need to be conducted in an agile way, such that a client can kick off the process, maybe hand it over to the professional, maybe it goes back to the client for more data entry, and maybe it's completed at that point. But it could also work out differently. That agility of that process is key, because every client is different, and but the client expects that transparency of seeing the process, seeing the progress, and being able to drive part of the way. In the lower half, obviously, digital is the predominant end-to-end solution. But again, these are two different spaces, and we see in the full service world, again, many firms starting to work on that integration, but it does take a particular solution, it does take a particular skill set in order to get there. In the advisor space as well, two trends I would like to point out. One is the goals-based wealth management direction, and the second one is the regulations, the DOL component. Starting off with the goals-based wealth management area, advisors are with that are pressured or are having the need to articulate their value proposition they deliver to the client. Particularly as the advisor gets undercut on pricing through digital models, pure play digital models, the goals-oriented way of conducting wealth management is becoming a key proposition to deliver value-add services to the client. Therefore, we see many firms working towards that type of direction. While many of them are on that in that diagram here on level 1, maybe Merrill Lynch is on level 2, and Northern Trust claims to be on level 3, which is basically working really from a goals direction and working assets that are inside and outside the firm, governed by those goals. Most of the firms are really stuck on level 1, and the importance as goals-based wealth management gets implemented at wealth management firms is that certain processes, be it onboarding, be it client reporting, be it every process really that touches the client needs to be lifted out of the product silo and towards the client front end. And that is a key change for many firms as they are looking at serving clients holistically, that they need to redefine the way processes are being conducted. Secondly, I would like to talk a little bit about the DOL rule, the Department of Labor fiduciary rule that is keeping the industry busy today. Obviously, in April, we saw the final rule coming out. There's much of haggling going on around what will it be. There's some lawsuits still going on. So it's still not quite settled, but we know the direction it's going towards. And we do believe that spending is being impacted by it at financial services firms. The goal is to provide consistent, conflict-free advice with guardrails that the home office is setting, that the firm is setting. So really that reliability on a process that makes a decision on what is the best product or the best proposition to offer the client is something that needs to be very closely controlled and needs to be conducted independent from product silos. And again, very similar to the goals-based wealth management proposition, again, it's something that needs to move to the client front end in order to be doing justice to the role. Again, when we look on the right-hand side of this picture, firms need to invest in process management systems that allow transparency in their process, also and an audit trail of the process. Investments in advice automation solutions is key, as well as the reduction of variability of commissions. The pricing side needs to be looked at as well. But the first two areas, again, the process management as well as the advice automation, are something that we're going to see a lot more of in the next 18 months. With this, I come to the concluding slide here. The takeaway to me is mass affluent firms must engage digitally with their clients. I think despite that many of them have a traditional business model in place, their transition towards digitalization is something that is a must and probably a question of survival. In the high net worth space, digital engagement is something that clients demanding as much as in the mass affluent space, but the advisor proposition is somewhat more sticky and therefore buys those firms somewhat more time. But we do not think that the digital need will bypass those firms. I think we will see very much high net worth firms embracing digital because the clients are asking for it. And the value-add digital experience and self-service tools are a key differentiator in the high net worth space, done on a very high-end type of way. In general, we see service differentiation as a necessity. Service differentiation based on client segments, but also on client behavior. So far, we've seen firms mostly segmenting clients by assets and the amount of assets a client brings to the firm. Much more we see going forward a client choosing the way he or she wants to interact with the firm. And then that is, again, something that firms are today not really well equipped in delivering. Why? That's the next point. It's really that robust client data layer is missing. Much of the data that is sitting at firms is sitting in an execution-oriented way in the back offices, where products are being sold, bought, managed, but not in a client-centric way, close to the front end, where decisions more and more need to be made quick, going across all the product sets. So again, an independent process layer, independent data layer is something that is firms need to get to in order to fulfill that behavioral segmentation need, but also compliance need. Financial advisors need to be able to articulate the value proposition in a digital world. What is that value add? And as firms start building out the digital capabilities, this question needs to be answered as well, is where does the client advisor need to come in? What is the value that the advisor needs to bring? It's a matter of profitability, but it's also a matter of client satisfaction and justifying the fee in front of the client. Goals-based wealth management, we do believe is the direction that the industry will go and will be able to leverage to justify that value that the advisor is providing, and ultimately visualize it to the client that there's value in that advisor's proposition. I have my contact details here as well, should you want to follow up with me directly, but otherwise I'm heading over to Derek.
Thank you. Hi, I'm Derek Corcoran, Chief Experience Officer at Avoca and based in our Colorado office in the US. In this session, I'm going to cover 3 topics. First, I'm going to position Avoca's solution for wealth management onboarding. Second, I'm going to discuss some of the best practices that we've learned for the creation of frictionless wealth management experiences. And third, I'm going to discuss some relevant examples of clients that have achieved significant results by leveraging the Avoca platform. As research from the IT Group shows, wealth management is at a bit of an intersection. Some firms are betting on robo-advice as the path forward, whilst others believe the best solutions for clients are provided by trained human advisors. And others believe the perfect solution is a combination of both. But if we focus on the client, it's clear that people want good advice delivered conveniently. And for some clients, that's by talking to their advisor. And for others, it might be by talking to Siri. But regardless of which type of firm you are and which type of clients you're engaging, digital has a role to play for self-service clients and advisor-led. And one of the most important components of that digital capability is the onboarding experience for new clients and new products. For most firms, onboarding is still a paper-intensive form-filling process, and the expectation is that digitizing this process will require a lengthy and costly custom software development project. In fact, Avoca looked at the top 10 retail banks in the US. We looked at 172 separate wealth management products offered by those retail banks. Only 14% of those products can be applied for online, and only 1% offers a mobile responsive experience for clients. Now, our product, Avoca Transact, is a platform for omnichannel sales transactions that allows you to rapidly digitize the onboarding experience for either advisor-led or self-service customers. And you can do that with minimal programming and rapidly. So whether it's IRAs, 401k rollovers, or trust accounts, you can leverage the rapid delivery capabilities of Avoca Transact to accelerate the digital sales component of your firm's digital transformation. Avoca sits behind the Apply Now or the Open Now button and has a focus on streamlining the onboarding process for the advisor and the client, whilst ensuring you meet the regulatory requirements for new customer acquisition and also support the kind of collaboration that a client and advisor might want to have. And we do this by providing our clients with 3 primary components. First, a powerful design tool that allows you to build the customer experience and the customer journey you want. You drag and drop pre-built widgets onto a template that embodies your style to create that customer experience. Secondly, we've over 50 pre-built integrations to technology partners like Yodlee, Kofax, DocuSign, Salesforce, for example, that accelerate the creation of your desired customer journey. Our platform opens up the world of fintech innovation. And finally, there's the server component of the solution that allows you to manage and optimize your onboarding experiences. All of this combines to allow you to create a frictionless omni-channel onboarding experience that supports both self-service and advisor-led service. And what we're bringing to our clients that they don't have today is the ability to rapidly transform that paper-oriented experience to one that's digital and frictionless, and then the analytics and the agility to optimize that onboarding experience, making it easier for advisors, making you an easier firm to work with, and making it easier for your clients. And we've been honored with a number of awards in recent times because our message is really resonating with the financial services industry. And what we're providing is a platform that makes your existing teams, your existing experienced developers and designers more productive than the approach that they're taking today. Now, with the project work that Avoca has done to date, and with that onboarding in mind, let's look at some best practices for creating a frictionless onboarding experience. So first of all, we advocate that you design from the customer in. So this means you need to understand your processes for onboarding in the back office, but design from the perspective the customer is considering. So ignore to a large extent the sequence or the orientation of your flow in the background and focus on what's going to make it easy for the customer to actually give you the information that you require to give them the right product set to achieve their goals. Secondly, there are a lot of services out there that can assist with pre-fill. So minimize the number of keystrokes, minimize the effort that the customer has to invest. So obviously we can do things like address lookups, but you can take that to the extent of taking photographs of driver's licenses to pre-fill about 70 keystrokes and about 11 fields on an application form, right through to services from partners like Yodlee, who can provide account aggregation services. So we not only have an understanding of somebody's financial position, but then that can be updated on a daily basis by leveraging services like Yodlee. We strongly encourage our clients to minimize the number of fields they ask customers to complete. Very often it's death of a thousand cuts. They just add another field, and all of a sudden the onboarding application becomes 20 or 30 pages. But when you look at whether or not all of that information is actually being used today, it can be very easy to minimize the number of fields that we're actually asking customers to complete. And if we do need them to complete them, make them as easy as possible for customers to complete. We recommend that our clients are conscious of information familiarity. So certain things I'll be able to answer quite quickly, such as my name, my date of birth, my social security number, but other pieces of information, such as details of my last 2 years of tax returns, is probably something I need to look up in a filing cabinet. So be conscious of the questions that you ask and how easily the customer can complete them, and we encourage our clients to sequence it such that they ask the tough questions last. Purely from an aesthetic perspective, when you're laying something out for smartphones, we strongly recommend you position labels above fields. That leaves more usable real estate on the actual application form for our clients to complete it. And it means that your eye only has to go vertically down the page instead of scrolling left and right. And onboarding for wealth management products, particularly in a self-service environment, can be complex. It can be a lengthy application form. So there's a high chance that a client may begin and then abandon. So we strongly recommend that you capture a lead early in the application process. So collect the potential investor's first name, last name, email address, and cell phone number. Store that as a lead. If they've given you those details, they're genuinely interested. They may not have all the time to complete the application right now. So if you at least capture them as a lead, you can follow up and see if you can convert them to a customer. And on that point, we strongly recommend you offer customers the ability to save a partially completed application. So just understanding the fact that life gets in the way, cell phones can drop out of battery, laptops can die, people need to run to meetings. Giving them the ability to save a partially completed application and come back to it will strongly encourage them to actually complete the application. And in doing so, you can then also support crossover between devices and channels. So I can start on a cell phone while I'm sitting on the train, and it occurs to me that I really should set up an investment account because I now have my first child, but I may not want to complete that on my phone. I can save it. I can pick it up on my laptop, which has a bigger keyboard. I could save it. I could actually speak to an advisor. They can bring up my partially completed application and help me complete it. Thirdly, application forms for onboarding into new products can sometimes read almost as demanding. We recommend kind of softening the language with some conversational language, particularly when you're breaking up between sections in an application form. As you can see in this example, just a soft little sentence like, tell us about yourself, can lighten the nature of the conversation. Next, we don't recommend the use of all capitals anywhere in an application form, apart from some people feeling like it's shouting at them. It's also actually harder for the brain to process. So especially if you're delivering things like instructions to people, whilst aesthetically you may feel that capitals kind of stand out and they're square and they look better, they're actually more difficult for the brain to process because you don't learn to read in capitals. So your sight words, the ones that you recognize without having to think about them, you learn to read them in sentence case at school. So if you provide instructions in sentence case or even labels in sentence case, it's much easier for the customer to recognize the word and process the information and do what it is you're asking them to do. We live in a mobile world